Hey, welcome back, everybody, to today's Market Explained. This is the FourStar Market Commentary Show, I'm Brian Castle, your host. I'm back here with Chris Reardon. Chris, welcome to the podcast.
Thank you, Brian. Good afternoon, everyone, and glad to be here. Glad to talk about a little about the markets with this chilly, cold weather we got going on here.
It's brutal. 2 degrees today, Chris, when I looked at the weather map, and it was every bit of that. And 9 below wind chills in Chicago, and we're not alone. We get it here in January and February, but the rest of the country's getting it now. So now they know how we feel, right?
Mhm. Very true.
So Chris is our director of development. He's the master of all things portfolio, tradings, advisor development, and he loves his Cleveland Indians Guardians now. And he's a young dad with a daughter and twin boys. So Chris, a new Reardon clan, welcome again to the podcast.
Thank you, Brian. Glad to be here.
And I'm your host, Brian Castle. I'm CEO and founder of FourStar Wealth Advisors. I'm a financial advisor myself, but I'm also advisor to CEOs and insiders in their financial world. I'm a trustee of the National Boy Scout Foundation and on the International Fundraising Committee of the World Scout Foundation. I'm the chief dad to Quinn and Evan and husband to the amazing Tripty. And if you are so inclined, um, give us a 5 out of 5 ranking on Apple iTunes. You can punch a little button that says 5 out of 5. That would be great. We're still a number 1% ranked podcast, and we want to keep it that way and keep growing our viewership. So the more likes we get, the better it goes. So thanks, Chris. We're going to do our standard program, no international today. We're just going to talk about what's going on here in America. So, Chris, why don't you lead it off? What is going on in the major sectors, the major groups that we track, and where are we today, about 1 month into the year 2026?
Yep. So yeah, as far as the major asset classes go, domestic equities is still in the number one position, but it is losing ground, if you will, or the gap's closing between domestic in one and international equities in two. So domestic equities lost 4 points from the last podcast. It's at 293 tally points, but still, as of right now, holding that number one position. International equities is in the number two position. It gained 9 points, so it's at 289. It's now within 4 points, within striking distance, if you will, of overtaking potentially domestic equities for that number one spot. Commodities is still a pretty distant third at 223. It was -5 since the last podcast. Cash is in fourth at 115, and it was equal since the last podcast. Currencies is in fifth still at 92 tally points, and that was +1 since the last podcast. And fixed income is still in last and actually continued to deteriorate. It's at 77 tally points, and that's -2 since the last podcast. So I would say probably the biggest thing right now is a potential change for that number one position to keep an eye on. And then outside of those, the top three, it's a pretty over 100-point gap, between the top three and the bottom three. So clearly a risk on environment, if you will, right now with what we're seeing.
So it's interesting, Chris, with the international making such a big move up and within a couple points of domestic equities for taking over the number one position. And a lot of that has to do with the weaker dollar. It has to do with the rally in precious metals and international equities are starting to really work. But there's also some good things in the economy. I know you're telling me earlier, so we're going to hear about that in a few minutes. International economy and international, certainly Europe has been more abound for a long time. And so it's finally starting on the margin to work, which is that's a good development. And I also want to note that fixed income can't get out of its own way. And ever since 2022, when rates spiked upward, fixed income has been ranked last, and it's still last after it's almost 4 years now. So that's really quite sad. But again, fixed income is a storehouse of value, and as long as you're a long-term holder, you'll get your bond to mature if you're in a treasury or a corporate bond or a municipal bond. So they're still useful. But they aren't, as far as like big possible upside gains, they're not considered to be the great asset class at this point, right, Chris?
Yeah, I mean, exactly. And I think, whenever you have a lowering interest rate environment, which we're in now, it tends to, impact bonds as well. So
Mhm.
probably, we're probably going to see it being last, at least for the foreseeable future, unless we see
Mhm.
any, other major unforeseeable changes. But so yeah, and then switching over
Yeah,
to
the sectors.
the
Yeah.
sectors, yeah. So year to date, so we're about, as Brian mentioned, about a month into 2026. The leading sector, surprisingly, is energy. It's up 11.76%. So yeah, I think some of this was more or less energy got so much beat up last year. It was kind of a very up and down year for it. And we've seen it kind of spring off in 2026, pop up a little bit here. Some of it, we have, I know we'll talk a little bit about it later, but we have the kind of the turmoil in Venezuela a little bit going on. Plus, a lot of the economics with the US continue to be relatively strong, and the global economics continue to be relatively strong. So usually when you have, the global economics in the US looking strong, the energy tends to do better. If you have demand, you have transports moving, trucks moving, all that stuff. So energy is leading the way, followed by materials up 10.75%. And that's really interesting because you would say energy and materials are kind of a 1-2 as far as a growing global economy. Materials being copper, all these things used to build and manufacture. The fact that those are 1 and 2 is a good sign, at least right now, for the global economy.
Mhm.
Number 3 is industrials. That's up 7.21%. 4 is consumer staples, which is kind of an interesting one. It's up 6.83%. And then there's a bit of a gap to that fifth spot, which is the kind of the last of the top half, and that's up 2.72%. And that is consumer discretionary. So very different grouping right now in that top half
Mhm.
there. Obviously, we don't see technology, which is kind of interesting. There are some tech names certainly that are running, in some cases up 18% in a week. I mean, or large moves, but as a broad sector, we're not seeing it move as much. So then going to the bottom half, the sixth best performing sector is information and technology. That's up 2.68%, followed by real estate in seventh. That's up 2.12%. Utilities at 2.03% is in the eighth spot. Then communications up 1%. And then the last two are actually negative so far in the year. So healthcare, it's about flat, but it's down negative 0.14%. I know some of that's healthcare insurers as well. So you got to be very careful within that sector as a broad, because some are doing better than others, but insurers certainly got beat up, especially this week. And then last place right now is financials, and that's down almost 2.5%, to minus 2.49%. So a little bit different of a makeup than we saw last year, which was pretty much dominated by utilities, communication, information technology, and materials and industrials. Now, it's actually industrials with the other big one up there. So a bit of a different makeup so far to start 2026, which, if you look in the scheme of things, is actually a good thing for the market, because if you just have the same 2 or 3 sectors constantly running, that just shows that those sectors might be getting overheated. We might be due for a big pullback. Once we see the breadth of the market expand a little bit more, we see consumer staples, which is great to see running. We see in consumer discretionary up there, industrials, materials. That's a good sign, as I said, that we're seeing an expanding economy, not only in the US, but a global economy. So,
Right.
so far, I think it's pretty positive, especially with what we're seeing to lead the way in 2026.
So I find it ironic, Chris, that we ended the year with utilities, communication, information technology, and financials like banks in the top 4 or 5, and they're now all in the bottom 5.
Mhm. It's certainly a reversal. And some of that could be, maybe since they were some of the top performers last year, maybe people thought they were overvalued. They kind of took them down a leg. I know specifically financials, obviously they're dealing right now with, um, you know, just I think certain event news driven things regarding, caps on interest rates, things like that,
Mhm.
that I think is just kind of causing extra volatility there.
Mhm.
Plus, whenever you're looking at interest rates potentially being lowered with the Fed lowers interest rates, you just see a little bit of extra volatility there because the banks and the financials there tend to have a little bit more or be a little bit more impacted, I should say, by those changes.
Yes. And healthcare had been rallying in the fourth quarter, but that has done the fade here in January as well. And interestingly enough, we're a couple days away from the end of the month, and they say often as the first month goes, so goes the year. So most years where January is down end up being down years in the market, and most years when January is up end up being up years because they reset the balance at a new level. And so not only to outperform does the market have to go up, but it's already got wind under its wings. Let's say we're up 5 or 6%, then they got to give that up to go negative. And historically, that doesn't necessarily happen when you consider that. So we're up this year already for the year, and a couple of sectors up very big. Energy, materials up 10% in a month. That's pretty big move. So we'll see. This year may end up being a positive year, and the signal will come in January. I think it's a 90% chance that if it's up, it'll be an up year. So that'll be our fourth up year in a row. But everyone said it couldn't happen. But yes, it could if the economy is better. Are there things that could take the market down this year? Absolutely. There's always news events. Last year was tariffs. So there's always things that could come out of left field. But as far as normal economy without dramatic news events, if the market's up, there's a good chance it'll be up for the year if it's up for January.
Mhm. I mean, and I think one important factor behind this too is, I think the current administration really wants, obviously, the market wants the economy to grow and is really committed to that. So we've seen that several times this year. As we've seen some slowdown, they tossed out ideas. Some of them maybe better, some of them worse. I don't know. I know the 50-year mortgage maybe got a little bit of flack, some certain things, but they're at least throwing out solutions on ways that we can maybe solve and fix and kind of continue this expansion. So, what that shows to me is that they are committed to the growth there and finding a solution to kind of, keep things steady and moving forward. So, time will tell. As we get into the economics, we'll discuss. I mean, we're seeing some positive, some negative. It's not all, all explosive growth, but so far the market seems to be doing off to a good start, I should say.
Brian Kasal. I'm the CEO and founder of FourStar Wealth Advisors. Now, we built FourStar on one simple belief that every client deserves clarity, confidence, and strategy built around their financial story. For over 40 years, we've guided clients through every market cycle, helping business owners, families, retirees protect what they built and then grow their holdings to meet the needs over their entire life for them and their family in the future. We are fiduciaries, not salespeople, and that means we sit on the same side of the table as you always. So from personalized portfolios to advanced tax and estate strategies, everything we do is about creating long-term freedom and peace of mind for our investing families. So if you're ready to align your wealth with your goals, visit fourstarwealth.com. Let's start building your future one smart decision at a time. Absolutely. And Chris, didn't the S&P hit a new milestone?
Yep. So just today, the S&P 500 hit 7,000 for the first time, which, I mean, some people, if you go back 20 years, 30 years, probably would have thought that would be impossible. But it did hit that today. And, like I said, I think the big driver behind that is the wind on the sails that we've seen, where we've seen the expansion of the market from just NVIDIA's, the Palantirs, these names that have been the primary drivers. And like I said, some of them are still running, but we're seeing the oil names come in here now. We're seeing some of these consumer staples come in. We're seeing all these other names really lift the S&P up a bit more there. So that's very positive to see.
Yes. Well, and we're seeing some other things. We're getting an injection of volatility as the lofty tech stocks, big equity valuations, and now they're kind of at the bottom of the barrel this year so far. But it's inevitable that they take a break. I mean, no group moves up straight up forever, but they certainly did last week. And this week, has seen a little bit of a rally in tech, but certainly nothing to take it into the upper half of groups. And then the Fed came out today, and they did not raise rates, so they're going to stay where they are. So no rate cut in December, no rate cut now. So there's, a chance that the tech stocks probably aren't going to run all that much because they were looking for a rate cut. Nvidia earnings are coming out after the close, and so we'll see how that goes. That's the biggest, most highly capitalized company on the stock exchange. And Bitcoin's slid below 90,000, down 30% from its peak. And so that's interesting development. While the metals are moving, Bitcoin is not participating as well. And people are getting out of Bitcoin and buying gold, silver, palladium, and platinum, and things like that. Chris, you mentioned University of Consumer Sentiment before in different shows. That came in below expectations, but now there was a reading for December that came above expectations. So we'll get to that, right?
Yep. Yeah, it was kind of a mix. It's funny. It was a mixed bag where one beat expectations and one was below. I think it was the consumer report was below expectations, but the University of Michigan beat expectations. So, once again, what I think that does a good thing highlighting is these aren't perfect metrics, right? I mean, they're usually going out and kind of surveying people, right? So, there's a high chance that, yes, it's going to give us an idea, but it's never an exact science, right?
Right. Yeah. So, there's a lot of interesting things happening right now. Gold has slumped a little bit after being on a big tear, but gold is still moving up, and a lot of it now we're getting calls from a lot of investors about gold. That's kind of typical. A year into the rally, everybody's trying to hop on. But if you do that, folks, and you do get involved in gold, it's very aggressive here. So if there's a pullback or a bad day, it's going to be a big bad day, right? So usually those stocks are down 5 and 7% because commodities move quick. So be prepared for a little bit of volatility. And then we're expecting 150 billion of tax refunds, according to the Treasury Secretary Scott Bessent. No tax on tips, no tax on Social Security. Markets are rallying on that. And we feel like we're in a bull market, Chris. And you can feel it when you're in a bull market. The market opens down big one day, and then it rallies to close or rallies to be even. That's a bull market. That's a market that wants to go higher. And of course, we've seen the opposite when the markets are down big and they stay down and they rally a little bit and then they go lower, or they'll open up and close down. And we see a lot of that in bear markets. This does not appear to be a bear market. And besides the fact that the numbers are going up, the breadth of the market and the feel of the market is very much bull marketish. These are the things we see in a bull market as compared to a bear market. So until we get further evidence, we're fully invested and we're in a bull market, right, Chris?
I mean, 100%. And I mean, it's really interesting, just in even the recent times, comparing this market to, you could say like a 17 to, for the most part, up to Q4 2018, where you saw a similar huge run in semiconductors, things like that. But that was off of Bitcoin. In a lot of cases, you had the Bitcoin mining, and then you had the graphics GPU units, and that was feeding the, whereas this is obviously mostly based on AI. And I think if you kind of compare both of those scenarios, what the big difference is here is, whereas mining Bitcoin is, I don't want to say a little bit of a side project, but it doesn't really have the economic impact that AI has, where we're seeing, some bad things as far as obviously people are being, jobs numbers, joblessness, let go jobs. So we're seeing that, but we're seeing productivity rise. But the impact it's having, the trickle down economics right now from AI is tremendous. I mean, you have one of the precious metals, silver, which is running heavily right now, is also an industrial metal, and it's used in a lot of these build outs for these data centers and things like that. And then the biggest, recent trickle down has been memory chips. The biggest runners, Seagate Technology, Micron, had 18% up week. So we're seeing this kind of trickle down outside of just the NVIDIAs and the AMDs and even the Palantirs. So that's overall good, and I think a good sign of an actual bull market that's got some legs behind it, because we're seeing it not just isolated in a single sector like semiconductors. We're seeing it trickle to all these other subsectors that are also being impacted by it. So overall, I think it's a promising, sign.
And the market multiples are not outrageous. If you look at an equal weighted basis, the average market multiple, if you look at the market cap calculation of that, which the large tech stocks and others with massive multiples dominate, then we're at record levels. But the reality is people don't buy stocks in the way that the market cap is designed unless they buy a S&P index, for example. So the way people buy stocks are equal amounts in each stock and diversify. And in that measurement, the market's not overpriced. It's a little bit above fair value, but nothing wildly overpriced except for the tech markets, and we're seeing them correct a little bit. So, Chris, what about the economics? Let's hear some detail there.
So on the major front, we got a Q3 GDP final number. It came in at 4.4%, which was slightly above expectations for 4.3%. So that was good. And obviously 4.4% is a pretty strong GDP number for America. So that's good. It'll be interesting when we get that Q4 because we did have that shutdown there. So that number may be a little wonky. I believe Jerome Powell actually even said that on some of his remarks today. And then the other big broad thing is the Federal Reserve held interest rates steady. They met actually today. So for the first start to 2026, we're probably, I think the anticipation now is we're going to be in kind of a holding pattern with interest rates, at least for the near term. Flipping over to inflation. So the December CPI came in at 2.7% year over year. That was up slightly, up 0.3% from November. The core CPI came in slightly lower, up 2.6%, only up 0.2% from the previous month. So, obviously we want to see that closer to the 2% as their target. The fact that we're seeing it slightly increase, but it's just something to keep an eye on right now. I don't think the Fed believes it's a issue yet, but certainly something to keep an eye on. The November PCE price index came in at 0.2% higher than in October, which was in line with estimates. And the year-over-year number for that for the PCE was 2.8%. So once again, we've seen a couple slight tick ups. I think it's something to keep an eye on. If it starts pushing into 3, 3.5, then we would maybe have to worry about or look towards maybe another either bull halt or things like that. Moving over to consumers and production. So the November retail sales came in at 0.6% up month over month. That beat expectations of 0.4%. That's good to see. Obviously, I think one of the biggest drivers in 2025, where a lot of people were anticipating a major pullback or a recession, if you want to call it. But the consumer overall held up really strong. I think that was a big surprise. So if we can kind of continue that momentum into 2026, that will be a very good sign. So something to keep an eye on. The January S&P Global Manufacturing PMI came in at 51.9, a little bit below estimates. The estimates were for 52. Once again, anything above 50 with these numbers is expansion, so that's good. The same January S&P Global Services, so this is not manufacturing services, this is the service sectors, that came in at 52.5, slightly below estimates at 52.8. So still in expansion with both manufacturing and the services sectors. That's positive with those retail sales. So that's kind of that good side. December's industrial production rose 0.4% in November. That beat expectations. The expectations were a 0.1% rise. And then durable goods orders rose 5.3% in November. That was a big beat. Expectations were only for 3.2%. So from a production standpoint, I mean, these numbers outside of that durable goods, everything's still relatively tepid. So we're not seeing any kind of explosion. But I think the promising part is a lot of people are anticipating these to pull back, to go into I'm going to say a recession, but to really kind of pull back there. We're not seeing that, which is good. They seem to be holding up, at least holding steady. Going over to consumer sentiment, the University of Michigan consumer sentiment for January came in at 56.4. That beat expectations of 54. But I believe today, Brian, I think, I don't have the exact number, but I believe it was the Consumer Confidence Board. Their number came in, I believe it was just below that. It was at about like 52. Which was below expectations for that one. So once again, just kind of almost like, wonky. I think the key is I think the consumer right now, there still is, from both readings of what I'd read, there still is a um anxiety over the prices and can people keep up? That is a constant looming. So until that subsides, I think we're going to still see it in the 50s, 60s, until we see that purchasing power increase.
Hmm.
But I think overall holding steady or moving upwards is something positive. The housing market, new home sales were minus 0.1% in October from September. So some of this is still some catch-up data that we're getting from the shutdown. Existing home sales were up 5.1% in December from November. So that was good to see existing home sales starting to move. But in that same month, pending home sales, so this is the overall pending, not just excluding the existing, they were down 9.3% in December from November. And that was a significant miss. The estimates were 0.4% up for pending home
Mm.
sales. So, I think the housing market continues to vex a lot of people. I know it continues to be something that weighs on the Federal Reserve and even the administration's mind. So I think there's still, we really haven't seen a solution in that front yet. And then I think the last piece of the puzzle, if you will, really the jobs market, so far has actually been a little bit better than people anticipated. Initial jobless claims for the first week of January came in at 199,000. That beat expectations of 215,000. So, I think overall the labor market, we're seeing a kind of a steadying there. We're not seeing it kind of continue to kind of free fall. We're seeing a bit of a steadying there, which is promising. If we can see that kind of steady out and maybe flatten and start to move back up, that would be a very promising sign for the U.S. economy as well.
Would. Good. That's a good report. And Chris, this housing market you mentioned, we're still about almost they estimate 7 million housing units short in America. And anybody who was around in the mid 2000s when the housing market went crazy up to about 2007, which was the high, it took 5 years to work through all that supply, and the market didn't bottom to like 2012. And then we had 5 million too many housing units. And now we're the exact opposite. But because interest rates haven't gone down that much, mortgage rates are still relatively high. The brokerage industry is tough. So we're not seeing a lot of buying activity in housing, even though they need it. Folks aren't able to buy because of the cost, and the real estate brokerages are suffering. So if rates were to go a little bit lower at any point soon, that could really help spike the real estate market. But real estate prices are very high. Builders probably won't build unless they know they can sell, but they have an advanced time, so maybe they'll start building now, hopefully. We have some investments in land companies that develop parcels of land to sell to developers. That's probably a decent investment here if you're playing the longer game, 2 or 3 year game. So there's a lot of interesting things happening, and housing could start to boom again here soon. We are seeing the additional dwelling units built on properties, for example, in California, where they're building another dwelling unit on the same property. But the key is they've got to unlock land to be able to build more. And that's been kind of political. And so they're looking at now forcing that. And that's one of the administration's work, is trying to make housing more affordable. And, we saw housing prices really drop dramatically in 2008 because it just got to be such a glut. The better thing would be to not see it go up very much and see people kind of grow into the housing market. But there might be in certain areas. I know in Florida, there's a downturn, in Naples, for example, in certain areas. So we don't want to see it collapse, but sometimes the real estate markets do that, right? And we'll see how bad it gets, Chris.
I mean, 100%. I mean, I think it's like a two-pronged problem, but you have the new building, and that's exactly right. I mean, you don't want to have this huge. You want building, but you don't want it to be so much, because if you have all these builders going in there, you're also going to drive up the cost of materials. I mean, that's the hard part. Is when you look at lumber prices, you look at all these things, it's expensive. So I mean, if you're entry level to buy a house for a single family is $600,000, it might price a lot of people out of the market just by the fact of that. So it's something to keep an eye on. But then the other big thing is existing home sales. I think that's the most important one. We see the baby boomer generation held on to their houses, I think, a lot longer. We're starting to hopefully see that move now that interest rates are coming down a little bit, things like that, where they think they can kind of get a good price, or they're going to start leaving. So once we see that turnover, hopefully that will free up. So I think the in between with both of those, I think will be big.
Yeah. Well, good. So, expectations for the future, or at least the future announcements, it's already happened. The fourth quarter GDP growth is now GDP now expected to be over 5%. That's exciting. Trump, of course, is pushing his view that he's helped make the economy recover, and in many ways he has. We haven't seen a 5% quarter in quite a while, so if that happens, that's really quite good. And then wind under the wings of the economy. We talked about unplanned tax refunds. Well, it's now a bigger estimate, 200 billion coming in February and March should fuel consumer spending. So that's why we feel the economy is going to be strong. Weird events notwithstanding, but everything we see points to a better economy, and usually that means better financial markets as well. How about commodities, Chris?
Yes, I mean the biggest news in commodities. I mean, obviously we already kind of discussed a little bit with oil. Oil's been obviously hot so far this year, but the biggest has been kind of what we touched on: precious metals. Gold hit $5,311 dollars an ounce for the first time ever. Big driver behind that as the weakening dollar, which you kind of alluded to in the beginning, which is driving not only gold but also driving some of the gains within the international markets that we've seen as well. So, in the commodities, precious metals continue to be hot. Silver, in some ways, is even hotter than gold at this point, both because of it is a precious metal, a store of value from that standpoint, but also it has industrial applications that are, as I kind of talked about earlier, that are really important to, whether it's semiconductors, things like that. So, precious metals continues to be strong. Oil has gone off to a great start so far in 2026. I'm sure it's going to have, as we saw in 2025, it's not going to be up probably 30 or 40%. It's going to go up. It's going to go down 5%. That's just the way oil works. I'm sure potentially in the next podcast, it will not be the number one. But, I think overall, as long as we see that stabilizing force there within the oil markets and even the broader markets with commodities, it's a good sign.
Yeah. Well, and along with gold hitting new highs, as you mentioned, silver, palladium, platinum, they're all up there.
Yep.
And we have allocations of those in various forms, in stock form or in commodity form in different accounts. So that's one of the hot areas. And of course, the materials group is number 2 ranked so far for the year. And then you mentioned oil, Chris. President Trump says he's attempting to lower oil prices partially by removing Nicolas Maduro and getting the oil markets in Venezuela moving again. And they once had manufactured over 3 million barrels a day of oil. They're less than 1 million now, and it's just through mismanagement and poor structure of the country. So when Trump is kind of crazy like a fox, so he takes over or by essentially arresting the president of Venezuela. He gets control of the oil markets there to some extent, and that could lower oil prices, but we don't see it to go lower a lot. It's going to take a long while to get back to 3 million barrels a day. But originally, Dulce Rodriguez, the vice president of Venezuela, is going along with it, and then just the other day she did a big rhetoric pushback. And then maybe she's just doing that for the cameras, and she'll still work with Trump in the background. We'll see how that all plays out. But we know that there are armed militia running around in Venezuela looking for Americans. So right now, there's a kind of a question as how all this is going to play out. And a lot of the big oil companies are still very concerned that they can make good profits there. Some oil companies say it's not really investable yet, so they're going to have to stabilize it in some way. So we'll see. President Trump is the ultimate card player. We'll see how he figures out how to make this work. But it could bring at least a stagnation in oil prices and lower prices at the pump if that were the case. And maybe that's good. Certainly for affordability is the big term everybody uses. But the other aspect of this whole thing with President Trump, by seizing somewhat control or all control of the oil markets in Venezuela, 70 to 80% of the oil sold from Venezuela went to China. So now he's actually controlling China at some level. And then, of course, they are having issues in Iran. And, so the Iran markets are really kind of a mess, and they're a big oil exporter as well. So it does appear like things are changing, and Trump may have done what he did just as much for the control of China as he did for the price of oil. So we'll see. We'll see where all that goes. And speaking of international, Chris, what else do we see in the international markets?
Yeah, two interesting things to highlight. So India's December industrial output rose 7.8% year over year. That's the fastest pace for India's industrial output in over 2 years now. So that's good to see. I mean, India has been one of those where you look at kind of everything they have as far as manpower, as far as kind of an industrial and everything. And you would think that they would be, to a degree, a powerhouse as far as, especially as a lot of places were pivoting away from China. But we really haven't seen that. We didn't see that the last year. So it's good to see them kind of turning it around. I know India has a big corruption issue there. There's a lot of other underlying issues there, but obviously that's good to see. And then I think this is fascinating here. So Spain, their unemployment rate to end 2025 fell to 9.93%. And that marked the first time since the 2008 financial crisis that Spain's unemployment rate has dropped below 10%, which is crazy. And we're actually one of the ETFs we own in our international fund is a Spain ETF. So we know that it's been, their economy's been doing very well as of recently. But that's good to see. I mean, in both these, when we talk about global growth, I mean, that's what we want to see. It's great when the US is doing good, but when we see global growth, that helps power everything and helps power the US back. So, it's overall very promising to see.
Well, Spain's from the chapter of the book, Every Dog Has Its Day, Chris. Spain has been a basket case for years, running 25-30% unemployment. So it's nice to see them recover a little bit, isn't it?
No, I mean, it's great to see them. I mean, it's like I said, you have to go back to 2008 and they just never really recovered from that. And it's been kind of like China, or not China, kind of like Japan, I should say, where, they just kind of stagnated. Obviously, Japan goes back to, even before then, 90s almost. So, but, it's good to see. And overall, I mean, it proves once again that we're seeing kind of a rising tide lift all ships. We're
Yeah.
seeing everyone kind of benefit from the global economy.
And we're seeing that all across Europe. And the German GDP for the first time was up. Their GDP has been kind of negative, just slightly negative, -1 or a little less than that for quite a while. And Germany is the largest economy in Europe, and they're really the leading economy, and they kind of lead the EU. And so we're seeing again dogs having their day. Germany is starting to grow again, which is exciting. So Europe is finally figuring it out. There's still lots of impediments to growth in Europe, although we're seeing more and more elections where they're change elections. There might have been a more capitalistic rather than socialistic prime minister in France. That did not quite happen, and of course, then they've put that person up on charges, Marine Le Pen. So it's going to be hard to see a conservative or a capitalistic prime minister coming in there anytime soon. But that did happen in Italy. It did happen in Hungary. It happened in Denmark. So more and more countries are turning back toward good old capitalism in Europe, and that's an exciting thing. And it's good for them. They've been dealing with immigration issues for years and stagnation and very socialistic ideas, and they're rejecting a lot of that, which is good. So now, how politics affects economics. There's a big uprising in Iran lately as well, and they now estimate that over 20,000 dissidents have been killed by the government. There's big riots in Iran, all around Iran. The mullahs are still using anti-Trump rhetoric, anti-American rhetoric, and so we did neutralize their nuclear capability earlier this year because they wouldn't stabilize. But now, of course, they're on the ropes. So we'll see if that government survives or not. But here's where government does definitely affect economics, where people can't even leave their homes and they have armed militias running around in Tehran. So we'll see how that plays out. But Iran is a big economy and it affects the world a lot. And the longer they're a basket case, the worse it is for the world economy.
Yeah, I
Um,
mean, just global instability. I mean, that's one of the reasons that we saw oil so strong, as you pointed out, Brian. They're a major oil producer. Any volatility there is going to weigh on the oil markets and kind of pop up the prices in the short term.
mhm. And President Trump has been very aggressive with tariffs, and then he's used tariffs to get political ends as well. We have brought in billions and hundreds of billions of dollars in tariff money this year. We'll see if the Supreme Court goes along with it. But it has certainly helped our budget deficits. But some countries are backing away, and Canada was meeting with China, and now President Trump is threatened to give them 100% tariffs if they continue to work with China on various things that they were working with us on. So we'll see how that plays out. It's politics, of course, affecting economics. And then the European Union, some of the leaders of the European Union are upset with Trump. You know, he kind of wields his tariffs and threatens with tariffs. So they did a big auto deal with the country of India, and they're going to be selling small subcompact cars like the premier cars in India. They're going to be selling small Fiats and things like that all throughout India. So that'd be interesting. It's broadening out the markets, and it could potentially hurt America's markets as well. But we'll see. Chris, what do we see out there? What are the kind of oddball ideas out there that we're looking at?
Well, interesting this year, SpaceX is currently weighing a potential June of this year IPO at a $1.5 trillion valuation. So that'll be huge. I mean, obviously that's one of the hottest IPOs, one of the hottest stocks. I mean, I think it's not only is it obviously the company from a revenue standpoint, but I think everyone thinks it's kind of a cool company, right? It's space, go to Mars, all that stuff. So that would be interesting to see if that does happen. And then Amazon recently, they cut 16,000 jobs in an effort to restructure and push AI efficiency. So once again, we're seeing AI push in a little bit. And I think we've seen this probably the last 5 years where we've seen a lot of these tech companies trim a lot of jobs because they did overhiring kind of post-pandemic and everything. So not too surprised, but one of the biggest reasons for this is there seems like Amazon's finally throwing in the towel with their brick and mortar approach for Amazon Fresh groceries and Amazon Go markets. So they're moving strictly to online and things like that as far as delivery. So that's interesting. Obviously, it's a bit of a pivot. So we'll see how that pans out. And I don't know what their books show, but maybe a negative on their side as far as that purchase they did a while back of Whole Foods, which kind of pushed them into this grocery market.
Right. Okay. Interesting. Well, we're seeing a lot of platforms affected by, all the changes in the AI market. And we did a recent podcast with a group that is looking to not only have AI help reduce costs, and we've seen that. We've seen some layoffs at companies, and that's a trend pretty well established. But we've yet to see really how to turn AI into growth initiatives. So we're actually looking at that even at FourStar and the financial advisory business. How do we make AI work for growth? And we're trying to figure all those things out. Some of those efficiencies can help, but it's got to be applied to a specific business, and that hasn't been figured out yet. So hopefully that all figures out. Chris, the other really interesting trend that I wanted to share with everybody is, there's Bitcoins and all kinds of different cryptocurrencies, but now there are stable coins, which essentially are just stable money like the dollar. And so stable coins are coming on as people are putting money and considering them as a substitute to bank money markets. There's beginning to be resistance from the banks, but if stable coins continue to come on, people could put their money in stable coins if they don't change in value. And that could be a risk for the banks because the banks need to bring in money and then lend it out to make money. If people aren't putting money in banks and they're putting in stable coins, that could change the whole banking system. We've got a fractional reserve system where they lend out at 10 to 1 and they lend out investment banking at 12 to 1 and all those metrics and how banks work. And so that could change the whole banking industry if stable coins really catch fire, Chris.
I mean, 100%. I mean, I think it'll be really interesting to see how, relative to the dollar and how it moves versus other currencies, how will the stable coins move? Will they be as volatile as Bitcoin? Or are we going to see, when the dollar depreciates for, say, the euro versus the euro? I think right now it touched at one point, a euro was, or a dollar, it was $1.20 for a euro, which is the highest it's been for a while now. The dollar depreciated that much. If we see less, kind of a free fall and less, more of a holding and a store of value within these stable coins, be really interesting. Do we see more people flock to those to help kind of maintain the value of their money?
Exactly. So that's interesting. And, is it possible? Sure. Whoever thought we'd have ETFs, right? So the finance worlds keep changing. We didn't have commodity ETFs as recent as 2004. And the Apple iPhone has only been here since 2006. Of course, we live on these phones now. What were we doing before that? So, so a lot things can change, and new things can come into the economy, and maybe stablecoins is the next big change, and it could change the banking industry in many ways, like the financial advisory industry has changed many ways over the last 40 years that I've been involved. So, anyway, Chris, I think that's almost it for the day. Um, one thing I did want to cover, so we always talk about where are we? So all this great stuff we talked about today, and markets are up, markets are down. We're looking for better markets. The economy looks better. What are we doing about it? So we have the FourStar protection plan. We talked about that many times. So 85% of the time we're fully invested, and when the markets are correcting in tough shape, like they were last March and April, we'll start raising cash and get partially or completely out of the market in certain cases. We are not doing that now. In fact, we are now back to fully invested. We did get to partially protected in the fall based on some of the tech stocks that were pulling back, but then that's all turned around and started to go back up. So we now are fully invested. And like I said, 85% of the time we are fully invested. So that's how we're playing it right now. And that's the evidence we see till we get further evidence of a change. We're going to stay fully invested. We feel this is a time that investors can make good returns. But if you're going to take outsized risk, you make sure you have to have a governor on that program. And that's how we have the protection plan to make sure that we protect downside. And we usually only sustain about a third, no more than a half, but more likely a third of the downside of any down market by using this protection plan. So it's an important tool for our investors to not see so much volatility. The portfolio returns were really good last year. In our last episode, Chris chronicled the performance of the different portfolios, and they've done very well. But if you measure the risk-adjusted return on an absolute basis, they did well, but because they didn't take as much risk to get there, they did a lot better. So there's always a number. How did the market do? And then what did you do to get there? Did you have the full index in your portfolio, or did you get there with taking less risk? And if you did, then your risk-adjusted returns, or they call it Sharpe ratios and Sortino ratios, are off the charts much better than the overall market. With the S&P having a standard deviation of 16, and anybody who remembers statistics class, 95% of the returns in any 1 year in the market appear 2 standard deviations either way from that mean number of 10%. And so if people look at that spectrum of possible returns, and the S&P is pretty volatile, right? And if we can avoid some of that volatility by raising cash in bad markets and not see a 16 or a 32% downturn from the mean, we'd rather do that, right? And so that's what the protection plan is all about. So anyway, I think that's all we have. I think we're fully invested, ready to go, looking for good things. Let's pray for our country, pray for America. Chris, anything else we have for today?
No, just for all of you that just got hit by the winter storm, stay warm out there, and we'll see you guys back in a couple weeks.
These are the dog days in Chicago, so this is when we like to leave Chicago and travel and to get out as it's warmer. But anyway, that's it for us today, everybody. Thanks so much. We'll be back again with another great episode. We're going to be doing some interviews this spring with a lot of different players in the real estate markets and other markets. So we'll be back with those interviews as well. Over and out for today. Thanks everybody for being with us. Bye-bye now.